Watch, but first we go to Mike at the world with the latest in Japan. Mike, the Nikkei rising. First time in 8 days. What's behind those gains?
Yeah, ending the week with a bang. Exporters rising after the yen dropped against most of the major traded currencies. Investor confidence also being lifted by companies' plans to increase capacity because sales are recovering. Seeing shares of Mitsubishi Motors gaining 4%. Now, the Asahi newspaper says Japan's fourth biggest car maker is going to hire 500 temporary factory workers this year because of rising demand for small vehicles. Sony makes half of its sales in the US and Europe, so it's benefiting from the weaker yen. Sony trading up by more than 1.5%. Sharp gaining 0.9%. It's adding 10% extra capacity at an LCD plant here in Japan to meet rising demand from TV makers. Still, it did not raise its sales target. It says it's going to sell 10 million LCD TVs this fiscal year. Tokyo Electron shares rising as much as 4.7%. It says that orders for machines that make flat panels and also computer chips were up 82% in the first quarter. That is a quarter-on-quarter figure, though. If you compare it to a year earlier, still less than half of last year's level. Tokyo Electron, of course, the world's second-largest manufacturer of chip-making equipment. And Fast Retailing raised its full-year profit forecast by 4%, saying it's going to earn the equivalent of $558 million. That's 19% more than it did a year earlier. Fast Retailing director Toshihisa Tokunaga says Asia's biggest clothing chain is going to get even bigger to be ready for the global recovery.
We are aiming to build a business structure that allows us to continuously open 100 stores a year in Hong Kong and mainland China. We are accelerating our expansion plan to become the #1 clothing retailer in Asia.
Shares losing steam, actually up by 2/3% at the moment. Fast Retailing planning to open 100 new stores in South Korea, another 100 in Hong Kong and China, and in the rest of the world, an extra 100 stores, has Linda.
Mike Fan, thank you.